Good day, traders. This is the daily market update live from the Tradelo trading floor. It's Thursday, the 20th of June. Some highlights from today's show. The Bank of Japan's credibility is being tested again. US rates markets are pricing in more cuts again, and jobless claims is in focus. Let's turn our attention and talk about some of the key overnight news events. The Swiss National Bank has cut rates again. Now, this wasn't necessarily unexpected. There was some degree of consensus that they could cut today given the slowdown in inflation. However, given GDP growth was steadily moving higher, there was some potential speculation that they may hold rates today and then cut again at the next meeting. However, the SNB has decided that they are going to safeguard the soft landing. They're going to safeguard this recent uptick in growth by cutting interest rates already today. So that brings the SNB's interest rates level currently down to 1.25. Now, as a result, the Swiss is obviously, or the Swiss franc is one of the underperformers today. But again, that's simply because the market needed to price in that cut fully because it wasn't priced in moving into the meeting. Now, next thing to pay attention to today is we have got the Bank of England up. And again, also an interesting one to keep a very close eye on. Not necessarily because they're expected to cut. There is no economists expecting a rate cut today. However, there is some speculation that Mr. Bailey could really signal a strong intent from the BOE to cut rates at the next meeting in August. Now, the reasoning why the markets are going to be watching this very closely is that yesterday we had some key economic data out of the UK. It was the inflation prints. And whilst the headline goods inflation, in essence, is now back to the BOE's 2% target, and it did come in lower than expected, it's the services inflation that's really causing great concern for the Bank of England. Now, keep in mind, from a macroeconomic standpoint, services inflation does tend to be lagging. So it may be a case today that the Bank of England is quite confident in signaling perhaps they are comfortable with moving rates lower as soon as August. Now, the pricing for August meeting is around 30%, so it's not a strong consensus that they cut in August, and that's why you want to pay close attention today to the BOE. If Bailey comes out and he upgrades his discussion around a rate cut in August, if he shows some strong signaling intent to begin the process of cutting as soon as August, the pound will likely come under some sell-side pressure. So keep a very, very close eye on that as we move into the Bank of England today. Now, let's talk a little bit about, obviously, the US equities. We are in roll week, which means we are likely to see some more sporadic type movement as we head into the roll tomorrow. So keep a very close eye on that. Roll does continue today. And then one final point is tomorrow we've got very key PMI data both from Europe and then from the US in the afternoon session. Now, this matters because, PMIs are very much a leading indicator of GDP growth in all economies. So pay very close attention to that data point out tomorrow. Now, looking at some of the overnight markets and some of the movement, well, interestingly, Europe is strong today. Okay, what we've seen across the board in European indices, we've got the DAX up 0.6, we've got the CAC up 0.65, and we've got the FTSE MIB up over 1%. So Europe is really, really performing well today. Now, why that matters is that, sure, we had a little bit of underperformance from Europe last week on fears of, a French election that could, shift away from the center. However, the market seems to now have priced in that risk and is getting back on this trend of, setting sort of price discovery mode. So keep a very close eye. That strong European performance should filter over into the US. And again, what that means is that the US is likely just to continue this trend higher. We are very much in record territory in NASDAQ, S&P. And so there's no real case to be shorting equities whilst we are in this price discovery mode. That in mind, obviously, we've also got a little bit of movement in the currency space. Like I said, the Swiss franc is down 0.75 against the dollar. But the real talking point is the Bank of Japan and the yen. Okay, yen is again down today, and that brings us to our next topic. The BOJ's credibility is being tested. Okay, we are now at the weakest level since 1986, and keep in mind, cast your mind back to the last couple of months, the BOJ's already intervened twice this year. Okay, the currency, the yen, is down 11.5% this year, and the BOJ thinks this is going to filter into higher inflation moving forward. as a result, Ueda has come out. He's told us that, look, we cannot rule out a rate hike next month because we are concerned that a weaker yen is going to lead to higher inflation. However, the market looks at this and is saying, we calling your bluff, Mr. Ueda. We do not believe you've got that capacity to hike next month. Now, this conviction coming from market participants stems from a report that came out yesterday, which is crucially important. And what the BOJ has in essence said to Parliament is that if interest rates are going to rise, ultimately financial institutions could incur very latent losses on their security holdings. There was, of course, a bank that came out yesterday talking about some of their losses, and we're talking about trillions of yen in losses that are going to be absorbed by the bank. So ultimately, this review that's been done by the BOJ is showcasing that banks could well be in trouble in Japan. Now, if you cast your mind back to last year when we had the little bit of a shakeout in commercial banks in the United States, we obviously had a couple of banks going under. We had Credit Suisse also last year going under. It's a similar situation in Japan, except it's on steroids. Why? Because the Bank of Japan has kept interest rates so low for so long that banks have not needed to manage their interest rate risk. And I think that's massively important to pay attention to. Participants are looking at this saying, the BOJ can say they want to hike all they want, but unfortunately, they now have another risk, which is they probably cannot hike interest rates. Otherwise, they'll blow up their own financial sector. So keep a very close eye on this yen. It looks as though there is going to be some volatility in the near term. We're going to see further depreciation from the yen, and that's going to force the BOJ into action again. They're going to be forced ultimately to intervene, buy up their currency, because if they don't, everyone's going to ultimately turn against the yen because obviously the BOJ has lost its credibility. So keep a very close eye on that. Now, we can obviously take a very close look at that yen chart, and you can see, we've seen that weakness. We're moving very quickly away from that 20-day moving average, and we are now back at that 158.5 level. So above there, we close week today above 158.50. Keep a very close eye. Tomorrow, we should see some more fireworks in that yen. And again, like I said, don't be surprised to see the BOJ intervene because they don't have a choice at this point. Okay, now moving to our next topic. Ultimately, the eco calendar is light today, but initial jobless claims are in view simply because of the weak print we had last week. Now, that in its own is not necessarily something to be of concern. However, when you factor in what's going on in the United States, since the end of May, we've seen a number of misses in some of the key data points from the US. In other words, the slowdown is happening, okay? It's very, very real. Now, does that mean we're in a recession? No, possibly not, but it does mean we are seeing softness in the headline economic data. Now, in order for it to turn into a recession, we need to see significant slowdown. We need to see significant absolute change in some of the data. So the chart I want to pay attention to today is looking back at 2008, because that is the last time we did have, quite a severe economic recession. And what you'll notice in the absolute change, if you look at the bottom half of the chart, is that we had significant misses on the initial jobless prints, somewhere to the tune of around 15,000. So we had really big pickups in absolute change of the number of unemployed people seeking benefits. Okay, and it was that sort of culmination of these really big tick ups that we had in the initial jobless that eventually 3-4 months down the line led to the economic recession, and obviously what happened in the financial markets. Okay, so keep a very close eye on that. Initial jobless today is very much within range. Okay, it's not like we're seeing significant upticks. Yes, we're seeing a slowing. Yes, last week's number was interesting, but what we want to see is, do we get more of those significant slowdowns, or do we perhaps get that really big uptick that all of a sudden everyone says, hang on, we could well actually be in a recession already. Now, turning our attentions to our last topic, it's all about US rates markets. Why? Well, because what we've seen since the end of May, I pointed out the economic data has been weak, and what we've seen is rate market participants are responding. If you look at the purple line, you'll notice they've put in another 50 basis points of cuts into next year. And that's the market now pushing out the rate cut cycle, not away. They're just pushing it out to start at a later date. Okay? So very much the markets are very much thinking that a rate cut cycle is coming. They think it's going to be 11, 12 cuts over the course of the next 3 years. And all they did was move the rate cuts they expected to come this year, and they've moved it into next year. And that's why the rates market has responded very aggressively. At the top part of that chart is the US 10-year, and you can also see that that is responding. We are seeing that slower, inflation / growth being priced into US 10-year yields. We've moved from 460 all the way down to 425. So we've seen 35 basis points of movement in the yields in the last 6 weeks. So pay very close attention. More weakness in eco data. We're going to see a continued trend higher in US 10-year bonds and subsequently lower in terms of yields. Okay, that is then obviously our rundown for today. Like I said, pay very close attention to that initial jobless today. Tomorrow is the PMIs, and that is going to take focus. Otherwise, make sure you manage that risk. Go make some money.